Market Sniper back at you. Indices. We don't do that many recently, if I think about it, indice work. So I thought I'd do some indice work with you for today. The SPX, that is the SP500 stock index. That's the candle charts I've got here. So let's just put on the eye. It's the candles, but I've divided it by currency in circulation. The blue line is the SPX on its own. So the candle chart is all the new currency that is being added in circulation. The SPX divided by is the candles chart. The blue being just the SPX. So now you know where you stand on that. I'm going to bring the annotations back, but this is how I've carved this chart up. For a feel for where we are, there's lots of people talking about the stock markets and overvaluations, and here's what I think is going to happen, and I want to show you what we've done here. Now, first of all, currency in circulation, that's a Fed Reserve number. It doesn't include international liquidity that's also flowed into the US stock market. So it's a proxy, it's not perfect, but there's a lot of money. In fact, let's see if we can add currency in issue. So that you can see what we're dividing by as a matrix. Currency in issue. Let's see. Come on. There you go. See if we can put it on there. Purple it is. Okay, it's getting a bit crowded. So again, let's just turn the eyes off. Can I turn the eyes off? So that's how much money has been pumped into the system. So if you take the blue line and you divide it by, it needs a log scale, by the way. So it's also got a new scale. So let me just make sure that's logged as well. There you go. It doesn't look quite so. So if you take the blue line and divide it by the purple line, you get the candles chart that I'm showing you at the moment. So that's the Federal Reserve's currency in issue number. Now, it's as good as the stats that gets given here, so I'm going to say it's far from necessarily perfect. But let's drill down to see for the century under review. So we're 1917 through to 2024, over 100 years we're looking at. How's it doing? So here's what I typically do with charts. So there's a lot of annotations in there, so it's a little bit overwhelming, so grow with me on the detail. We tops and tail it, the green line, that one here, the solid green line and the solid red line. Where were the extremes to the upside? So you had kind of, for example, let's just stay with me on the red line. So you had a bit of a head and shoulder here. That was an extreme. It formed perfectly there. You had a super over pump and a bit of a iceberging event there. And you had another head and a shoulder on the rebound there, and you had all of this. So 170, 1.7, it's not a real number. It's circulation, currency in circulation. It's just a number. And 0.85 was the logical wick capture point for the real buy point. So by the way, where were these big sell points? 1925, which was an early warning for the turning in 1929. Then again in 1935 for the turn in 37. So this was a double whammy of a liquidity, a pump, dump, pump, and then final dump. That was giving you the biggest equity buy signal of 1949. That would have done you exceedingly well just after the war. This is boomers. This is boomers time. Right the way through into the 60s, 66, 65, 66. That was peak. You wanted to be into gold and other things during that period. Of course, Vietnam War, the stagnation, boom, big buy. So there's only actually this century been 3 macro extreme undervalued. So beyond the undervalued there, I also did dotted lines which take you to the extreme undervalued, and that was my technical points that I chose, 2.25 and 0.75. The orange dotted line is the midpoint of the overvalued line and the undervalued line. It looks higher because this is all log scale. The candles chart, which is the blue line divided by the purple line, has also been log scaled. So that's why it's, you know, it's horizontalized. It's not going up from top left corner to the other. So let's take that down and just highlight where we are on the map and how this kind of, what intel does this actually give us. So I'm going to remove the purple line. Just wanted to show you that, but that's what we're dividing by, just to clean the chart tiny bit and get a bit of real estate back. So what are we seeing here? Well, we understand now that the depression years were absolutely outright exceptional. That came with a run up. The roaring 20s, oh my God, roaring indeed. They must have been an absolute blast, and what a hangover you got after that. 1929 all the way, you went from a super extremist overvaluation. You smashed undervalued, you rallied back to extreme overvalued, and then you went super undervalued. Beyond even the extreme undervaluation that we drew. So that was the deepest dip, the wildest ride. Okay. Everything else is almost not quite as big as a roller coaster gig as that one was. But 1949 to 66, this extreme overvaluation, there, bang. Now that's the peak where you cross the top line. These are where you cross the dotted line. Now I want to highlight that again, the exception here was you crossed the line in around about January 25. Now this is 6 months, so it could have been January, February, all the way to July, or June at least. And then you turn. The turning candle is here. You can see already that the SPX is already heading down. The top was actually there, 29 in January. So it's kind of 4 years. That was a long blow off. That was an exceptionally long blow off once you crossed our extreme line. Over here, for example, which was the mid-30s. As I say, very, very volatile decade for equities and all of that. It must have made people very jaded to stocks for a long time, which is why you got that super undervaluation in 1949, Benjamin Graham, value stocks, all of this story. So July 35, boom, you crossed, which could have been July right the way through to December. We don't know when it crossed because it's a 6 monthly chart to give us a century of data. The turning one is actually there. And in actual fact, you can see the market turned before that. So that's July 36. So I'm going to change that to July 36 because I was looking at when it turned on our actual candle chart. It was already turning the equity market there. Bang. So you can see normally that's not nearly as long. And you could have crossed any time in that quarter, that half, my apologies, year. So it's July, August, September, October, November, December. Then you go January. The next candle you can see, if you look at the bottom, is January 36. That is half year 36. And you were already at your peak and getting ready to turn. Even though this traded higher during that quarter, it closed lower. So from that you can see, okay, 1 year. On this one, 1 year. That one, 4 years. From extreme overvalue overshoot to turning. Now, why is he doing this? You're thinking, you're watching this YouTube, why is he telling me all this? We're going to go through, there's only 3 or 4 instances, because you have just done, not just, the first half of this year, Jan 24, you're now already in the December half, which is still pumping, crossed the extreme overvaluation. We want a segment of data that's going to tell us how much time do we have with pumpermentals still in the equity markets, and with the amount of currency that's been thrown in. Quite a lot of people pointing out that in actual fact the currency, let's put that chart back on again for a smidge. Currency in circulation, put him back on. Oh, I did something stupid. There we go. I didn't do log scale, so let's just take him off. And I didn't do same scale. Let's see if we can fix that. He's gone. Sorry about that. Let's do it again. Currency in circulation. Okay, gotta start again. Let's add something new. Currency in circulation. Same new price scale. That's what we want. And then we want it logged. There we go. So they are actually rounding this one out a little bit. It's getting a bit convex after some pretty steep climbs and then a mini surge there. You know what happened there. That was March 2020. Boom, boom, boom. Okay, but it's actually convexity, little bit of flattening out. And you don't have too much flattening out. You had quite a lot of it here and a bit of it here. But you can see there's a bit of flattening out. Everybody's been used to the big 45-degree line in issuance. in here. Okay, so we had 4 years at the first instance. That was instance 1. Let's bring that back in. Instance 1. We had 1 year in instance 2 from once you crossed overvaluation. So here's your first official cross of overvaluation, January 65. And when did the market turn? That was its localized top. So that was kind of July 65. However, it came down, but then you reflated for a shoulder on the liquidity, and actually that was then a localized top. You came down, and then you actually made a final high over here. So the market went sideways in a broadening structure. It was zigging and zagging. It was choppy as all hell. Actually, for me, you would have done just fine getting out over there. But in truth, the market was higher over there, July 72. You were higher in July 72. So I went Jan to Jan for 1 year because you started a down leg there. And you ended up going in a lot of chop that ended up going a lot lower. But it did trade higher. So you can go 1 year on that, or you could go something else. You could go 72, but that's kind of super dodge because you would have gone up and down. You would have sat through a lot of volatility, a lot of broadening. So in actual fact, the volatility got kind of wide here. You can see it, and you ended up at the low end here. And it took quite a lengthy period before you crossed. Remember, this is 6 months charts. These are decades going by here. So, 1980. So it was a dark period. Of the 70s, stagnation, dark old period. So I'm going to stay with a 1 year there, 1 year there, 1 year there, 4 years there. Now we come to 2000. You crossed there on that candle, our extreme overvaluation draw. Let's just do it. Boom, boom, bosh. 1st of January 98. Now, if you see the topping on the blue line, boom, it was July 99. That would have taken you to December 99. So it essentially was to the cusp of the millennium was that. So July 98 to, and again, I'm not doing it to 2003. I'm going to change that to, I'm going to say July 99, which is that half, which essentially is 2000, the beginning of the year 2000. That's about 18 months. So 18 months, 1 year, 4 years for this first time ever mega stock market extremist event. So now you have a choice. What is the current window? In other words, we're going to blow off some more, I think, in equities. People are going to call tops too soon, but we are in extra time. In terms of the macro, we're looking at a 6 monthly chart. We are in extra time. You may get another candle, you may get another 3 candles, but overall, you're in extra time for a top out in equities. And, the last time you visited extreme undervaluation was 2009. It's getting to be nigh on, by the time this tops out, almost 20 years ago. And it's only happened 3 times ever. So it depends what kind of melt up we have. We could do Great Depression melt up, pumpermentals liquidity, pump up the crypto markets, pump up everything, major surge. We go all the way into 2025, 2026. The liquidity keeps coming. This purple line turns back up. You get 2 or 3 more candles here, each one representing 6 months. So, you can do a 3-4 year biggie, and then you get the depression slam down. That goes a little bit with the reset thinking, in that other crashes are going to look like small beer compared to this. So I won't rule that one out. That means you're going higher for quite a bit longer. Could be 3 years longer, 2 years longer. 18 months longer is getting into more of the category of what I'd call typical, and there's nothing particularly typical. These are huge moves, but this is more 66 and 2000. If we do 1929, we're going to blow off even higher. At the moment, the rate of this candle, which is almost close, it's a July 24. We're in December, guys. The year's done. You've got 20 days left of December. This one's going to remain another melt-up candle. So as long as that's melting up, when they start hanging and slowing, that's when you start to get close to the top, when you get a red one. And then we will only know afterwards when the stock markets turn down, and you definitely want to be out once the candle chart, the equity divided by the liquidity, is actually breaking back down through the dotted extreme overvaluation line. You definitely want to be out. Ideally, you want to sell the top of the market. But that will happen, there was the top of the market. There you were still just turning down of the market. And then there you were chucking it down. And then you ended up at that low. And these were all the way down. So I'm highlighting these relative jaws. And in fact, I took a kind of a screenshot to illustrate this. And I just did some overlay sketchy things for those big turning moments. So let's go black so you can see it. So you can see that's the triggering of the extreme overvaluation. That was only when this topped here and started turning down, and it was the top of the market. So that came 4 years later, extreme one. If we were to get that, we had a 2024 January. 4 years from that would take you to 2028. That's a long time of market pumpermentals. So if it's a great reset and it's going to replicate the extremity of the... Bear in mind, the markets were a lot less sophisticated then. There wasn't electronic trading. There wasn't that much global liquidity. Only American investors were involved. So it was more siloized. I think it's a bit of an outlier. But at the same time, I'm not saying it can't be bigger than these other corrections. This one here, number 2, number 3, and number 4, which is the dot-com bust, which went into the subprime super value undervaluation event. So you're going to have to decide, are you a 1 year, 18 months, or are you the 4 year? And maybe you're a little bit of both and you're waiting to see. But at the moment, this candle is finishing streaking higher. That means by valuation, you have already passed number 3. You haven't passed number 2 yet. So if I draw a straight line here, which was the echo pumpermentals, the 30s. Let's go back. Try to get a straight line here. So that one is still higher. And this one is marginally higher. But you are ripping to catch up with that. If the liquidity starts to slow down and the stock market is still just everybody buying, and that could happen with people exiting the debt markets, by the way. More and more people realizing debt's a busted flush, and they're exiting the debt markets. That could be the liquidity that keeps the stock market going. That brings you more into the category of 1929. I don't think anything beats 1929, but you could supersede the Echo 30s boom. You've already surpassed the 60s top, which was the run up from the late 40s all the way to the 60s. And you're bearing down on the 80s to the 2020-year bull market. Beautiful upside HVF there against the liquidity, which is showing you that was going to be a super surge. That was roundabout time, just as Greenspan said, it was about to say irrational exuberance, and it went on and on for another 4 years. Again, people will call tops possibly a bit soon here, and until this slows down, first of all, this chart slows down, you aren't going to see a slowing down in the equities unless you get a very marked violent turn down on the liquidity currency in circulation chart. It is showing a flattening, but right now the stock market still surges. So overall, people are probably likely to call a top too soon. This is a much more clear-cut, violent break of the extreme overvaluation level. It surpasses 2000 and it surpasses 1966. 2 big selling years, 2000, 66, 35, 36, 1935, 36, and 1929. So you actually had big selling years. You had more selling years than extreme buying years. It's part of the financialization of everything. Central banks becoming more and more players in the market. And so the solution has always been liquidity. So it makes sense that you've had 1, 2, 3, 4, 5 sells and only 3 super buys. But we are due a super buy, and we're counting this fifth one as a sell. We haven't yet got the turn point. What's the delay on it before the turn point comes in? For the extreme overvaluation of equity to the amount of currency that has been pumped into the market. This 2024 market is showing me it is more violent than 2000, 66, and 35 to the upside. I'm not sure, and data here is super spotty, but this was a champion. I think it's a champion, and I think we could turn on this chart, possibly taking out all these highs but for the 1930s. So if you're asking me, of the 3 possibilities, the normal, none of these are normal, they're macro busts and booms, but the normal extreme overvalued that we have, number 2, 3, and 4, I say we're surpassing them. So I'm to the upside. Are we number 1, the original Great Depression? I'm coming unders there. So there's a midpoint turning around here where I think all these relative valuations will be taken. And at the moment we have extreme pumpermentals still in place. We've smashed that 2.25 there, and we are going well through the extreme overvaluation level with real momentum. And I think that carries into January, and we need to see this liquidity line start rolling over a lot. And as I've said, you have the deflating bond market, which is going to be a continual liquidity provider as asset rotation takes place and people become sellers of bonds and say, well, what else? What other game is there in town? Expensive equities is probably the only other place. At least there's big market caps, there's a lot of liquidity, etc., etc. However, we've already seen on insiders, much less purchasing by CEOs, valuations are deemed steamy. Outlooks in terms of retail and consumer are pretty poo. So, but in spite of that, money has to have find a parking place. And at the moment, equity is still favored. But watch as pension funds start to have their heads turned to crypto and rediscovering gold as reserve assets, as the allocation away from bond markets continues. It can't all go to the equity markets. It may also go to crypto and gold in lieu of asset reserve status. So we are seeing the death of the ability to finance on ridiculous issuances of debt market, and there is not the appetite for it. It is not the performing asset, and it's risk adjusted following it correcting 45% from our bond top call in 2020 all the way down in 4 years. For the return it's giving, that level of correction, it's no longer a stable asset, and on a risk adjusted basis it is no longer sought after. And I will continue to expect rates to creep up despite pullbacks, and the bond market to be devalued, shrunk down, interest rates up, and that liquidity will be flowing into the alternatives of what was considered a reserve asset, but actually wasn't. It was a 40-year bull market with ever-increasing capital prices, even though it was slowly, and reducing interest rates, which was still giving a yield in an alleged low inflation environment, even though assets were inflating extremely. By the time commodities inflate, you're already late in inflation. Assets first. It shows proliferation, hypervaluation of assets. Okay, guys, so that's my take on equity markets. We're probably going to have an overvaluation that exceeds the 1966 highs, the 1936 highs, and the 2000 dot-com highs. However, it's likely to turn before we reach the extremity of the 1929. However, the bust will be brutal. Note how things unwind when you get well beyond, and there's a bit of mass psychosis. Things unwind pretty brutally and can get extremely volatile. time to consider the other assets, the reserve assets apart from equities. However, don't be in a rush to short, because you could wait 18 months, you could wait 4 years. Okay, my guess, we're going to get another green candle first half of next year, and then second half you may well have your first red, and you might be looking at the top, and then it could get disorderly beginning the year following, 2026. So N25, we could have a red here, and it could be a violent one. Could be something like one of these big guys on the downside. We'll see. But so I'd say 18 months, 2 years is my middling guess. Okay, till next time, I hope you found this little bit of charting extravaganza with associated prognosis useful. Also point out, if I can, on a parting shot, please note that the turn often happens here before you get back down. So we look at these critical points when you return, move back down, when you break down away from, the equity market is usually turned well before then. So you see how the first rejection where you get a red candle was indeed the top here, not back down there. The first rejection here, up top here, was there. The first rejection, this was kind of a curious, the 60s were kind of curious because you went into that broadening structure of ups and downs. In 2000, you'd broken, you had green candle, but actually your top was there. By the time you were doing that, you were already halfway down the hill. You were losing a lot of ground already. And actually, the big buys, as we showed in that draw, there were only 3 great buys, but this was your super valuation. And this is something to consider, because everybody will be so off stocks if we go through this experience. And you could get an extreme undervalued. That's when you throw everything in the kitchen sink at being a buyer, and I'm highlighting the tops, and then when you reverse away in these red and green arrows. But if you look at this, you got the 3 sells, excellent sells. You got a buy on a localized low when you are extreme undervalued and you finally start the journey back up. So the green candle, that is the beginning. Now you wouldn't know that because you might have bought that one and then you went lower. You could have even bought that one. But actually the S&P was going up on all those greens. You could have got in any of those entries there. But if you took the last one, which was the final leg, that was a great entry all the way up to 66. 66, you saved yourself from a lower low at some point, even though you were higher. You got the great 1982 entry, which is basically made for Warren Buffett. He essentially has been a massive net long of cash generative companies that saw him buy other companies with the cash generation throughout the extension and expansion of multiples. And that's made him a super billionaire. 82 all the way up into 2000. You wanted out of 2000 and back in at 2009. Look at that entry. You would have bought in there. You would have had the perfect low. Go and check Nvidia's price in 2009 and you'll probably be counting how many shekels you didn't make as a result of that. And we are still in the net long phase, but we've gone into injury time, and it's up to you to decide. 6 months, a year, 18 months, or maybe up to 4. Who knows? How high do you go? You tell us, when's your top for the S&P 500? I'd love to know. And what do you think it will do on the downside? Will we get to extreme undervalued again? Are we in type 1? Or will we do something middling in between the pullbacks that you've had since? By the way, even 3 made extreme undervalued. 2 made extreme undervalued and was part of 1. And number 4 did just by a wick make extreme undervalued. So either way, there could be a great buying season coming at the bottom of the next crash that needs to still come, and that might take 2 years, 4 years before it even starts. Okay, I love you and leave you. Liking and sharing is awesome, and we appreciate you. Help us through the 75K. We're going to be super happy about that. Cheers for now. Bye.
Tired of profit wipeouts and blown accounts from following trade signal groups and other YouTube channels? Looking for a better way to trade, reduce your stress, and minimize your risk? Become a skilled technical analyst and see the charts and markets in a new light using the successfully proven HVF method by Francis Hunt, while being surrounded and supported by a principled, structured, and experienced community. Enjoy a constructive learning environment while practically trading markets, supported by a bespoke platform run through browser and app, specifically designed to teach and engage you whilst learning and growing as the markets move. This is not a Telegram or Slack signal group. All trade ideas are based on a proprietary technical analysis process honed over decades, which is the HVF method, leading to trade ideas with fast-moving breakouts and tight stops, exact entries and exits, nuanced interim considerations, and ultimately, strong rewards. Submissions are graded and scored by Francis for potential high-quality setups, and we provide bespoke tools to help get the job done properly and with precision. Over time and with focused effort, you'll begin to look at charts and price action just like Francis. Community updates every day by Francis and our 3 webinars a week provide a 360-degree approach, which are presented by our experienced team of trade leaders to spot potential trades. We're a community of self-actualized individuals, spanning the globe and active 24/7, 365. The premium community provides a warm, supportive, and cooperative place for people willing to listen, participate, contribute, and to learn. We've changed thousands of traders' lives. Transform your approach to trading now. Transform your life. Book an introductory call with us on the link below.